Hey everybody, this is David Skarica. Hope everybody's doing good. Stock chart of the day. So today we're going to look at the bond market. This is kind of very interesting to me because we need a trigger. Like I've talked about how markets are overvalued, stock market to GDP, and I've talked about how I'm like a real contrarian right now. And it's funny. There's like the word is irony. The irony is when we have presidents with like what you would consider to be anti-growth policies like Obama or Biden, you get these big stock market booms, right? Um, um, you know, uh, uh, and then when you get these policies of people that you thought would be pro-growth policies, like Bush, or obviously the biggest scenario would be the Republicans in the late 1920s, early 1930s, you get these huge stock market crashes. So the question is like, what can cause this market to go lower? And I think interest rates are going to be something that's very key here. So you can see this is the 10-year bond. You can see now we're not quite where we were a few weeks ago, but we're basically back to where we were back in June, July. This was kind of the peak of like the expected rate cuts, and now you can see a lot of that has come up. We're actually up about 80 basis points on the 10-year bond. And if we go look at you can see that the 2-year bond is, or sorry, the 3-month treasury is still falling in yield because the Fed is going to probably cut next week. And actually, what's interesting is we no longer have an inverted yield curve, but actually, just so people know that when the yield curve goes from inverted, like you can see, it was negative 50 basis points back in June to now positive 13. Every time that's happened, let's quickly show you the chart here. We're going a 50-year chart of it. Every time that's happened, you can see going back to 90s, 1990, 2001, 2008, 2007, 2008, um, um, 2019, 2019, 2000, there's been a recession. So every single time. So one, two, three, this has only happened 4 times in the last 35 years. That's all this chart goes back to, but it's 4 for 4. It's pretty good, right? So obviously recession would mean reduced earnings too. So, but what's interesting is you would think, okay, well, if we're going to have a recession, that's actually disinflationary. Interest rates should actually go down. Usually people buy bonds when the market goes down. But I think again, this excessive government debt and too much debt out there kind of puts pressure because if you get a recession, you have government spending that goes up, even if they do try the CAPE thing. And then if they do CAPE and they cut spending, remember that's going to take money out of the economy and it's going to be short-term recessionary as well. And maybe who knows how much it could help because you could be in a vicious spiral where because you're cutting so much spending, all of a sudden those people that were, even though they're being paid by the government, but they're also paying taxes and that sort of thing too. So in the short term, you could have these maybe deficits don't budge because the revenue part of the equation goes down. And I think there's another part is like, look, one thing where I'm not like pro Trump on again and over is using the tariffs as a tactic. I don't like that. I think that's like if you're going to put tariffs on someone economically, fine. Sometimes I get it, like in the case of Canada or Mexico, if you believe that illegal immigration, because illegal immigration can also hurt your country economically because you increase crime, putting pressure on wages of middle class and lower class people. So I get that, right? But like with places like China and all other places all over the world, like he's putting pressure on the BRICS, like but what is Brazil and India really doing to the United States right now? You know? So and I think at some point that backfires because if you look at the foreign holdings of US debt, all these countries that own trillions of dollars, they'll just say at some point, and I'm going to do something on the next week on the Suez Canal crisis when it happened. They'll just say, hey man, we're going to dump. So I think what's one thing that might be happening here is foreigners might just not be buying. They might not like this rhetoric. They might not like the tariffs being used as a negotiation tactic. And this is where this kind of thing can backfire, right? So obviously it hasn't hurt equity markets. S&P's down a little bit the last 2 days, but nothing much. And you can see, the US dollar is still kind of trading near its highs here for this move. But I think this TLT is very interesting. And like if we go look at a shorter term chart, let's go back and look at a 1.5 year chart. You can kind of see this 89, 90s support, and then the next support is 85, and then we're talking about the lows of last year, which were the highs of this interest rate cycle, by the way. Or I guess it's almost going to be 2 years ago because we're getting into 2025 in a month's time. So this is this thing that I think that could really destabilize the market. And of course, this would actually probably expedite the whole Doge program and government spending if these rates continue to go higher and continue to raise the cost of borrowing at the government level. So again, this was kind of a quick stock chart of the day. I don't think sometimes you don't need to tell it too much, but I think this is something to really watch because if we go look at the S&P here, let's get an S&P chart. You can see this tiny little move here started to move lower since, basically for about a week or so. But very, obviously not very anything of significance. But maybe this is the thing that can kind of see equity markets start to crack. Look, there's still a lot of chasing going on. Portfolio managers want to show that they're in the winners, end of year window dressing. I don't see much. Look at next week, we have a 5-day trading week, and then Christmas is really is like a 2-day week. The Monday and the Friday will be 2 weeks because I consider like basically Christmas Eve and Boxing Day to be holidays, and then same thing with New Year's, Christmas Eve and and then you have like a 3-day week, the week of New Year's, because New Year's Eve and that. So basically, you're talking in the next 3 weeks. You got 5 trading days next week. You got 2 the week after. You got 3 the week after. So you're going to have 10 trading days in the next 3 weeks, basically, right? So, and a lot of them are going to be like, like the Monday at the 23rd and the Friday 27th. That Christmas week is going to be completely dead, you know? Um, so like, and those 2 days, the 30th and 31st before New Year's, are going to be completely dead. So really, we've got basically, I would say, 5 real days left in the next 2.5 weeks of trading. So I don't see some big flush out happening in the markets, et cetera, et cetera. So, but anyhow, I think this is something to watch for next year, is that this TLT continues to decline and long-term rates continue to go higher. We have a trade on this. I've talked about it in the past. Maybe I'll revisit again. I think the LQD shorting corporate bonds is a way to play that trade, by the way, because they'll be much more affected in a recession than government bonds. So, and the premium is very low. So if you do get some kind of big decline, the premiums will blow. And I've been out of this trade for a while. I've been in and out of it the last few years. I do think this is the next big short trade, but we'll talk about it more at another time. So everybody take care. And I hope you enjoyed this video.